morning and welcome. My name's Tim Murphy, Director of Manager Research Asia Pacific here at Morningstar, and it's my pleasure to welcome you to this, the 15th edition of the Morningstar Investment Conference here in Australia. Like many businesses over the last year or so, we've had to pivot and think creatively about how to bring you the best of what we do. Many of you joined us last year in 2020 for our all-digital event, and what a great day that was. But certainly one of the overwhelming pieces of feedback coming out of that was, even as the world normalizes somewhat, you really were keen for us to offer hybrid style events in the future. And so that's exactly what we're bringing you this year in 2021. We've got 2 days of action-packed content to really challenge your thinking, share meaningful insights, and really send you back to your offices with things to think about for how you build client portfolios. Of course, today on day one is our all-digital day. So we're going to be kicking off shortly with a really thought-provoking discussion with one of the great asset allocators and certainly notable bears in Jeremy Grantham, who's got some great insights to share. We'll be having a discussion with our global CEO out of the US, Kunal Kapoor. And followed by that, there's going to be a range of Meet the Manager sessions where you'll hear from a range of different fund managers around their particular insights at this point in time. You'll be able to earn CPD points from attending those sessions, as well as obviously drawing on many of the insights that they've got to share from a range of different asset classes and selection of managers that we've got for you to listen to here today on the digital platform. Then, of course, tomorrow, we're excited to be back in person for many of you. We're still offering the digital option for many others of you as well. So we'll be in the ICC in Sydney tomorrow in person. Big room, great event. Looking forward to seeing many of you in person for the first time in a while. We're certainly very excited to be able to bring that to you and hold a big in-person event and all catch up face to face again after what seemed like a very challenging time over the last 12 months or so. If you made it this far and watching this, you've obviously had first success in getting into our online platform, which is obviously great to see. If at any time throughout the day you are having technical difficulties, please use the help tab up the top, and we'll try and address those and get things sorted out as quickly as possible for you. Across the top on those various tabs, you'll see a range of different things there to check out over the course of the day within the platform. Of course, you've got various sponsor virtual booths. Events like this very much supported by a range of sponsors, so we thank each of you for your support and certainly encourage you to visit and engage with each of the sponsor booths in there. Of course, we've got the Morningstar tab as well to hear about all things Morningstar and what's happening with us, updates on our various products and services, and chance to interact with various staff members from Morningstar and help you fill the needs of what's going on in your business. So please feel free to jump in, interact with the Morningstar staff, and let us know how we can help you. And for those of you on social media, we're using the hashtag again this year, MICAU. So please, with any of your social posts, use that hashtag, tag us in. In particular, we'd love to hear and see pictures of where you're listening to today's events from. So please use the hashtag and let us know what you're up to. So now it's time to get into the content for the day, and what a great way we've got to kick off our opening keynote with GMO's long-term investment strategist and co-founder, Jeremy Grantham, whose views on markets are certainly very well known, particularly for their bearish nature. So we've got a great fireside chat happening now with Morningstar CEO Kunal Kapoor. I'm really excited to hear what Jeremy's got to say, because there's certainly some really sharp contrarian views in there. So let's get into it and hear what Jeremy and Kunal have got to say.
Well, I'm excited today to have this opportunity to speak with Jeremy Grantham. Jeremy, thanks for taking the time to speak to our team in Australia and all the folks that are attending our investment conference in Australia. It's really great to have you here. Thanks for making the time.
It's a pleasure.
I thought we'd start just with a personal question, if you're comfortable. I wanted to just ask what the past year to 18 months has been like for you, both personally and professionally.
Well, we had a totally overprivileged existence. We're down in beautiful countryside with 50 acres of our own of woodland. So we spent the first year getting to know nature every day, examining the cycle. in a way we've never done in a weekend summer home. We got to know a handful of neighbors discreetly and became friends with them. We did a bit more reading than normal, and I did quite a lot more research than normal because I wasn't wasting my time on airplanes. So my carbon footprint was magnificent. And I was reduced to worrying about rather small things like amortizing my tie supply. If I could wear 3 at a time, I would.
Well, sounds like it's been a good year from that perspective. But you also had some nuggets in there that sort of indicate that maybe your behavior changed, obviously, and that's been a topic du jour for everybody these days. And I'm curious, as you think about the investment research business, what do you think are the long-lasting impacts of the past 18 months or so on the way people will do their work?
I'm hoping they'll be a little longer term oriented, a little more interested in things that can go wrong, in the black and gray swans that lurk off stage. I think COVID might have taught us that. We hadn't been learning that quickly with climate change, but I would say finally beginning to learn a little. And COVID is just a reminder. Those kind of issues that are not your routine quarterly earnings type of issues are nevertheless much bigger deals in the long run. Yeah. I started pushing climate change 13 or 14 years ago, and I can tell you there was a lot of eye rolling from our clients and from the general investment world. And time passed, and finally you look back and you find the oil has gone from 15% of the S&P to 3%. And that whole new industries of wind, solar, energy efficiency, new agriculture are everywhere. So it creeps up on you in a very interesting way. And I think people are more willing to think about things like that now than they were a year ago. They were beginning to tilt towards climate change and longer issues, perhaps a year before COVID. But this has really encouraged us to be a little longer term, which is brilliant for me because that's what I do.
Yeah.
I quit portfolio management proper 15 years ago and spent my time only on the very big issues.
And so as you think about where you spent your time, you mentioned you'd been doing a lot of reading, some research. Obviously, you have a number of well-developed views, but I'm curious, as you've been spending time thinking about the future, have you started forming kernels of new ideas that you want to explore further that have long-lasting implications? What might some of those be?
We have a bee in our bonnet about toxicity. I think pesticides and plastics are doing a job on our health and the health of the insect world and the health of the whole natural world. And our sperm count has dropped, in my opinion, looking at the data, to a third of what it was the day I was born, say. And that's a hell of a drop. And the first 80% of that drop didn't matter. We were over-engineered like a good Victorian bridge. But finally, it's whittling us down to a level where in the last 10 or 15 years, it's begun to matter. And we've gone from almost nobody having trouble to about 15%. 1 in 8 anyway, young couples having trouble. And it's progressing almost 2% a year. And which is a sinister number because that's about the rate that the insect population is disappearing. And it's showing no sign of slowing down. And that makes me feel that the plastics industry, the chemical industry, pesticide industry are all under potential threat from toxic lawsuits. And I got this in at a Morningstar conference 3 months before Monsanto got sandbagged with glyphosate. And Bayer has lost the entire value of Monsanto from its relative stock price.
Yeah.
And it's only one of 3. There are 3 big chemical hits already, and there'll be many more. And plastics are just getting warmed up. Plastics leach what they call forever chemicals into the water you drink and the food you eat, the wrappers around which your food is wrapped. And these are, I think, a completely underestimated shock, which will play out in the next 10, 20 years, alongside climate change, of course, which is gathering speed as we sit.
So when you talk about changing behaviors, the rise of awareness around climate change and the willingness and ability for people to be longer term focused, it strikes me that one of the most important things in the investment business that may have to change as well is the incentives that are put in front of analysts, portfolio managers, asset owners. Feels like those incentives still are disconnected from some of the views that you're espousing. And I'm curious how you think about incentives evolving, to fit sort of the longer term mindset that you're obviously advocating for.
I don't think it's an issue at our firm. And frankly, I've been sufficiently busy this last year that I haven't wasted a minute on secondary topics. It's an interesting topic, but I have no interesting thoughts.
Yeah. Well, let's shift over to a topic that obviously you have spent a lot of time on, and that's just the notion of valuations at a high level. And when I say valuations at a high level, I think we can look at some of the global indexes that are popular. And I'm just kind of interested when you look at the different asset classes. As you reflect on the past year, the strong gains pretty much everywhere. What do you think that means as investors think about the future and some of the deliberate choices they're going to have to make?
Well, the higher an asset price is, the lower the return. You take a nice simple example, buy a forest or a farm in Australia. In the old days, it would yield 6%. Today, it yields 3%, approximately.
Yeah.
And not only is it much harder to get rich reinvesting 3%, so you double your money every 24 years instead of every 12 years, and in 48 years, you're down to a quarter of what your wealth would have been. So having high-priced assets is great for retirees, old folks like me, selling off my assets. But for everybody else, it means you compound your wealth more slowly. And if you don't have any wealth, you pay twice for a house that your parents paid. You pay twice for a portfolio in the sense that you get half the yield. It's a fairly miserable world. So I welcome lower asset prices, which I'm confident will come from these very high prices. Even a modest retracement back towards the last 100-year average, if it went back halfway, is a major bear market today. And the other thing we have to watch is if you're going to have a bubbly market, make sure you only do it in one major asset class. So don't pull a Japan. Japan had the biggest bubble in history in land and real estate, bigger than the South Sea bubble, in my opinion. It also had the biggest equity bubble of any advanced country. And pulling two at the same time means 31 years later, or is it 32? 32 years later, their land is not back to where it was in 1989, and their stock market is not back in nominal dollars to where it was in 1989. And that's a perfect example. As the higher you go, the longer and greater the fall. Japan had never sold over 25 times earnings, and at the time, it was shown that it was 65 times. What the historical revisionism is, I can't say. But that's a pretty hefty new high from 25 to 65. And the same in 2000. We'd never sold over 21 times earnings, and then the tech bubble took us to 35. And 10 years later, we were selling at a lower price. And that's how it works. You can't get blood out of a stone. You can have a high-priced asset or a high-yielding asset, but you can't have both at the same time.
And so what do you think some of the triggers might be that could lead to this reassessment of the valuation of different asset classes?
Well, they're still arguing about what caused the 1929 crash. we have not been good at identifying, and it may be because there is no traditional pin to pop the bubble. The market hits its all-time high when optimism is at an absolute peak. And the following day, it's the second most optimistic day in history, but it's a shade less optimistic than it was yesterday. And the price begins to fall a little bit. There used to be a ping pong ball on a jet of water experiment. And you turn the jet of water up, ping pong ball would rise a bit. You turn the jet down, the ping pong ball would fall, but it wouldn't go all the way down until you turn it off completely. And that's what's happened. We've turned the pressure up and up, more money, more moral hazard, da-dum-de-dum, and here we are at the peak. So it won't take bad news. It won't take a thoroughly bad economy to start bringing this market down. It will take a perfectly good economy and perfectly optimistic outlook, but a little less than it used to be a week ago, a month ago. And in 2000, what we saw is we saw the really optimistic crazies, the pet.coms, peel off in March of 2000. The rest of the market shrugged them off as crazies and the market kept rising. And then they peeled through the growth stocks and finally they shot Cisco for 8 seconds, the biggest company in the world by stock market. And by September, the 30% of the market that had been growth was down 50%, but the S&P was unchanged. The rest of the market had continued to rise by 15%. And then the termites, the optimism termites or the pessimism termites would be a better description, finally got to the balance of the market and the whole 70% rolled over and dropped 50% in 2 years. And what do we see this time? We see that the super crazies are really anything to do with the electrification, EVs for sure. Tesla is the king of that group, and the SPACs. And the intersection, the SPACy intersection where they're EVs or batteries and so on, was perhaps the most outstanding degree of enthusiasm, exaggerated enthusiasm. And they're down 30%. The SPAC index is down 30%. The last 10 SPACs, having announced a deal, are now less than the $10 that they do these deals at. 9 out of 10 are below the $10. It's only a few months ago in December where they'd come at 10 and they'd be 50 or 100. Indeed, the one I own, QuantumScape, came at 10 and within a few weeks was 132, currently 27. So I found myself in a paradoxical position of warning people against SPACs, and then the VC that we bought 7 years ago turned into a SPAC.
Yeah. So amidst all of that amidst that big picture, where clearly, we're in a unique time with unique asset prices, interest rates being low, debt being high, possible debates around whether inflation is going to be real or not, energy prices in fluctuation. Are there any pockets that you see today that you think are interesting from an asset class perspective around the world that you think people can earn a decent return on, or do you feel like you're going to have to just be defensive for a long time to come?
It's closer to that. 2000 was brilliant. Bonds were incredibly cheap. TIPS yielded 4%. Real estate sold below replacement cost. You don't want to pull a Japan. And we tried to in 2008. We had a genuine housing bubble in America, a 3 sigma, 1 in 100-year event. And it sucked the equity market with it. So it went all the way back to trendline, the housing market. And it took the S&P down 50% with it. And those two combined packed a much bigger punch to the economy than had the tech bubble in 2000. And 2008 also had yet another asset class, the oil and commodities, spiking in 2007. So they inflicted quite a lot of pain on consumer income, and that made the recession even worse. And this time, you look around and you find that real estate is suddenly pretty bubbly in almost every interesting market in the world. I have to say, notably, including Sydney, but Vancouver and London, Paris, New York, San Francisco, all over. And our housing market is up 15% in the last year. I think yours is up 5, 6, or 7, but still, you can't keep an asset class like housing where the house doesn't change and you're just marking it up in real terms year after year. Eventually, there'll be a day of reckoning. And remember, the higher the multiple of family income, the longer and the bigger the pain is likely to be based on Japan and based also on the US. So we have housing pretty well everywhere. Real estate has been pushed up. Farms, forests, as I said, almost everywhere on the planet have doubled in price and halved their yield. The bond market, as Jim Grant would say, is the highest in the history of man. You know, we have records going back to the Babylonians, and there's never been these kind of negative real rates. Over a quarter of all sovereign debt will charge you for the privilege of buying their bonds. They won't pay you anything, you will pay them. I mean, that is amazing. And then it comes to equities where, yes, it isn't so much global as the US. The developed world is merely overpriced, no big deal on its own, but the US is heroically overpriced. And emerging markets is actually fairly cheap. And then within the structure of equities, as we all know, all us value managers know the hard way, has had a brutal 11 years. It was the worst 10 years in history for value versus growth. And then last year was by far the worst single year. So you had the worst decade followed by the worst single year. And value is certainly as cheap as it has ever been against growth. And there's signs over the last few months that has shifted. And if you look at the intersection of these two ideas, emerging markets and value, I have complete confidence that if you bought the intersection, cheap emerging market stocks, that you would get a perfectly handsome 10 or 20-year return. And I am pretty darn confident that you will not get a handsome 10-year return from, say, the S&P 500 or NASDAQ. NASDAQ has, by the way, peaked quite a long time ago, 2 months ago, and is now up 5 versus the S&P's 12. Remember, it has a higher beta. When high beta stuff starts to underperform, you want to watch out. 1929, the flaky, junky, high beta stocks underperformed the whole year so badly that they were down year to date the day before the crash. They did the same in the Nifty 50 era of 1972. S&P was up 17, the average big board stock was minus 17, so I can remember, nice symmetry. And then in 2000, as I said, all the growth stocks went down and the rest of the market went up for 8 or 9 months, for 8 months. And this time, my guess is the super specs peaked in January, the NASDAQ peaked in February, and maybe in a few months, the termites will get to the rest of the market.
Yeah. You alluded to the fact that value had started to make a comeback. And when our analysts look at value stocks and value strategies, at least this year, it seems like a couple of your strategies have lagged even within the value part of the market. And I'm curious if that's because you feel like you've continued to own a more conservative stance versus other value strategies as well, or just kind of what sort of broader thoughts do you have on that topic?
Well, actually, I think that's wrong. Our most of our funds, I have to say, for the first time in a long time, are beating their benchmarks, and we have a lot of funds, like most people.
Yeah,
and I'm sure we have.
We're looking, Jeremy, at the recovery since November, and looking at the 10 largest funds that you have, and only 3 out of the 10, I believe, are in the top quartile over that period, and so that's where that question was coming from.
Okay, well, they do bounce around, but year to date, most of them are in the top quartile. But that's what happens when something as significant as value versus growth changes. It doesn't change as one homogeneous block it also phases in based on industry. And some industries, like climate change related industries, have been brilliant and started to move several months before.
Yeah.
And airlines and so on were special cases. But we've had a lot of problems over the last 11 years, but this year has not been one of them.
Yeah.
And I can't speak to the leads and lags, but our international, our US quant funds and so on are all doing much better than normal and beating their value universe.
Yeah. I want to shift gears a little bit and slowly start moving to the topic of climate change. But before I do that, I did want to ask you a simple question just around the surge in commodity prices around the world and the fact that just even outside of sort of the traditional asset classes, if you start looking at the various commodities, you're basically seeing, any significant commodity also sort of surging to multi-year highs. What's your view on what's kind of going on the commodity side and whether that is sustainable? And obviously for investors in a place like Australia, that's a very important topic, energy and commodities. And so I'm interested, and I'm sure folks would be interested in hearing your perspective on that topic.
Well, I wrote I guess you could call it a well-noticed paper in 2011 called Time to Wake Up. The era of falling prices and commodities and plentiful supply are over forever. And that was not meant to be, and I did actually spell it out, that was not meant to be a short-term forecast. In fact, I said if China slows down or the weather improves for agriculture, this could be a local high. And of course, China was quite indecent in its behavior. It accelerated for the final 4 years of its super cycle to 10% a year in its demand for iron ore, Australian iron ore, and coal. And then the following year, it didn't slow down. It didn't go plus 11, plus 9, plus 7. It went 0. It was dead flat, as you know, in Australia, probably better than any group on the planet. But for 3 successive years, they had no growth at all. And not in 1,000 years had any producer expected that kind of brutal shock. But here we are, 10 years later, 8 years later, and a lot of those metals are back to highs. And without China in rampant mode, China had grown from 5% of coal to 50%, and the same with iron ore. And now, somewhat flattish in comparison, the prices are way back up. And I think the long-term argument, I have to say, I think I was right. It was a paradigm shift. We had gone from 100 years of irregularly falling prices. Yes, they'd go up in World War I and World War II and the oil crisis, but in between they kept coming down. So over 100 years, they lost 70% of their real value, which is a huge help to getting rich. And then from 2000 to 2008 and then 2011, they bounced up more than they had in World War II without anyone getting too excited. And I believe, of course, it was mainly China, but that created a new era where we've kind of entered the end game, where from now on, instead of routinely falling in the long term, some will rise, some will fall, some will be flat. And you just have to get used to the fact that there's not a tailwind any longer. And from time to time, copper, there is no way copper will not rise hugely from here because of the electrification of everything. And that goes for cobalt, it goes for lithium. And all of the metals except iron and aluminum are really scarce. And we've done a pretty good job over a couple of 100 years of mining out the really high-grade ores everywhere. Yes, there's a lot of aluminum, and in the end, there's a lot of iron ore. You may have squeezes like we have today from time to time, but in the end, there's plenty. But everything else, they're really, really scarce. You add them all together, 20 coppers and lithiums, and they aren't a tenth of the amount of iron ore. Not even close, by the way. So I think, yes, you have to be reconciled in the long run for a different world of commodity prices. What that means for the next 2 years, I leave to other people.
Yeah. And what do you think the shift in the relationship between China and the West also means for asset valuations? Because certainly it seems like geopolitical risk has increased during the course of the past couple of years, yet that has not been something it seems like the markets have at least acknowledged in a meaningful way up to this point.
In the long run, the markets seem to ignore political risk and always have done. The day before World War I, the bond market was selling at a normal level, as if it wasn't even ascribing 1% chance to the war breaking out. That was the day before, by the way, not a year before.
Yeah.
So, and the reality is, unless there is a war, these political crises do not seem to have that big an effect on the stock markets. So yes, it makes everyone feel nervous, and it should do, because the chances of a Cold War and a hot war rise. We should feel nervous. But in the meantime, anything short of a pretty hot war, it probably doesn't signify that much for the stock market.
Yeah.
And in the run-up, if a Cold War begins to take place or gets more severe, there'll be more diversification efforts to make sure that you can source from other people, and you have at least a residual, a bare minimum in your home market. And that's not great for global growth, but it's great for some players, and will make it a more complicated world.
Yeah. Now, you've been laying out the case for climate change and its effect on asset valuations for more than a few years now. And at our conference 3 years ago, you made a very compelling case for why it could be bad news for companies that don't start to pay attention to some of the risks and what it might mean for their operations in the long run. One thing that has stood out for us, at least in the period since, is that a lot of investors have started to engage with companies and starting to talk about these issues more thoughtfully than was previously the case. But there's also a school of thought that disavows engagement and believes that divestment is the better option when it comes to companies, particularly in sectors such as energy, mining. And I'm interested in your perspective on whether engagement or divestment is the better strategy, or whether they both have a role in how you think about them.
I think engagement for the routine concerns is the way to go. And for many people, engagement is suitable. I think oil is somewhat the exception, because the oil industry ran a deliberate campaign of obfuscation, political propaganda, to deliberately mislead the world. They funded dozens of organizations to put out basically fake news that it didn't really matter, that climate change was a hoax, et cetera, et cetera. And the oil money was behind all of the above, and some coal money when it comes to that. They've played a very big political role, including in Australia, to confuse the issue on climate change. And that should be criminal. I mean, it certainly has had a very damaging effect. I think they did it very well, you might even say brilliantly. They're very good, the merchants of doubt, as the tobacco guys were. And just as it cost 10 years of hundreds of thousands of deaths in tobacco, it's cost the world perhaps as much as 10 years of progress on climate change action and government support and sensible regulation to move us in the right direction. This is absolutely a threat to our existence as a stable global society. And we're not winning yet by any means. The year with the biggest increase in carbon dioxide in the particles per million was last year. We haven't even second derivative. We haven't even started to decrease the rate of increase. It's increasing faster than it ever has. This is, 20 years into the battle, and it's still accelerating. And everything that one reads is accelerating. The rate of glaciers melting is accelerating. The rate of the ocean warming is accelerating. The last 30 years are 3 times the warming of the 30 years prior. These are really kind of alarming rates. The precipitation, the flooding has gone up very steadily, handsomely in terms of numbers over the last 50 years. And simultaneously, forest fires. And forest fires, it's not that there is less rain. In fact, there's more rain. What there is higher temperatures. So it evaporates the available water supply in parts of the world like Australia and Southeast United States, California. It evaporates the water more quickly and leaves it more vulnerable to fires. So all these disasters are accelerating, and we're simply not winning. So we have to treat climate change as the mother and father of all exceptions. We have to we need a wartime-like effort to get behind it, but at least a Manhattan Project. We need to put masses of money into research and development, into nuclear too, into fusion research. You can't afford to miss a trick. You don't know in the end what may save our bacon. But I would engage with every situation that I could do. But with oil companies, I think they're simply too cynical and too clever for engagement to count. And some of our universities said they would go for engagement, and I sit with bated breath to wait for their engagement program. We'll get behind you, dear leading university, but nothing happens.
Yeah.
When you get down to it, there have been very few special climate change type engagement programs. For routine situations, though, voting greener, voting better is a very powerful tool. And BlackRock and the boys en masse are moving at least steadily in that direction, slower than I would have liked, a bit slower to start, but now they're moving faster, and they are to be commended.
So what I also heard you say through those comments is, in some ways, if you're a fiduciary, it is also a matter of fiduciary risk. And getting behind these issues actually helps you discharge and fulfill your fiduciary duties. And yet, I think you would agree that this is maybe one of the hottest topics. There's probably not a day that goes by when there isn't something on the Wall Street Journal editorial page arguing that it's a matter of fiduciary risk, or that you're ignoring your fiduciary risk if you do take ESG considerations into your analysis. And so how do you sort of fall on the argument around fiduciary risk and how fiduciaries should be thinking about this and talking about it with investment committees, with folks whose money they've been charged to take care of? Like, how can that dialogue be a little bit more productive and a little less siloed than it is today?
I suspect that E, S, and G are all going to be indicators of better management. And the ones that move quicker and position their firms will get more of the bright kids signing up, will have more customers in the end. I suspect it will be good for business, but that is not my area of expertise. When I go to an ESG conference, I say, guys, S&G, they're terrific. Some of my best friends are S&G. What's not to like about good behavior? But E is a matter of survival. And it's clear that if you ignore E, you're likely to wake up and find that the biggest industry loss of value in history is behind you, and you missed it. And wasn't that subtle, by the way? There was never a year where people came out and said, oil industry is collapsing. It will collapse. Watch your tails. 1 minute, by the way, in 82, it was 23% of the S&P. But 10 years ago, it was 15. And then irregularly 14, 13, 12, 11, 10, all the way down to 3, actually hit 2.5 for a while. That all happened without people really pounding the drums. It's going to happen. Yes, I was pounding the drum of climate change, but I wasn't saying, and I was saying you should sell oil because it's the right thing to do. But very few people predicted the biggest loss of value in the history of the S&P, going from 15 to 2.5. Nothing like it. And, you may have seen, I presented it at your conference, where we took out each of the 10 big groups of the S&P permanently. And it hardly affected the return. Who knew the market was so efficient whether it was consumer durables or whether it was oil or whether it was utilities and so on, each major group missing since 1925 had only moved plus or minus 8 or 10 basis points around the average return. Quite remarkable. So it seems the market may be gloriously inefficient in bubbles every 15 years, which we know it is, but it does a pretty darn good job in the long run, equating growth stocks with high yield stocks and so on.
Yeah.
There's no easy free lunch to be had at the sector level.
So Jeremy, a lot of what you've been laying out obviously makes sense if you're overseeing a large pool of money and you're allocating assets and you have access to all kinds of information and data that allows you to make some of these decisions. I'm interested in hearing from you about what you think an effective decision-making and implementation framework might be for a financial advisor or an individual investor who's starting to think about these issues and maybe doesn't have access to all the information and tools that someone like you may have, yet they are interested in starting to make a shift in their portfolios to reflect valuations in the way you've talked about them, climate change and some of its effects. How can folks individually start to make a difference vis-a-vis kind of waiting for the institutions they rely on to do that?
Well, they can make a difference by buying climate change funds. I'm happy to say GMO has a pretty good one. ESG funds, where many reputable firms have them, that would make a difference. It would be good if we had a better rating on all the funds' voting records, how green they are, and it's something the Grantham Foundation is working on. And let me just say a word about our foundation, because we have a completely different investment approach, because we decided that American capitalism seems to me past its prime, a little fat and happy, not aggressive enough. There's only half the number of people working for firms 1 and 2 years old than there were in 1975. So we're losing some of our dynamism. But there is one thing where the US is still exceptional, and that is venture capital. And venture capital is really attracting the best people these days. They don't go to Goldman Sachs to write algorithms. They go into venture capital or to start a new firm. And they should. Venture capital is not like private equity. It's not, or institutional investing. In the end, we have to admit, we're playing a cosmic poker game. We're trying to beat the hell out of the other players. And it's fun. But we're not really creating net value. But venture capital is. We are causing firms to exist that otherwise would not exist. We're raising money for them. And in some cases, some of us are giving good advice to them. But America does that very well. And we decided in our foundation to go for broke. And we are aiming at 70% of everything we have in early stage VC, of which half to be in green early stage VC. And we have our own team doing that. It's thoroughly exciting. Boston is a great place to do that. We started more new ventures last year than San Francisco. That's a fact, by the way. And it's just amazing what new technologies are out there. Microbes that will sequester nitrogen, fix nitrogen in the ground. And batteries that will last twice as long and weigh half as much and won't burst into flames. The list is completely endless. And the challenge is endless. So this is going to be where all the opportunities are. And even if you look at the FANGs, or the FANG type companies are what separates the US stock market from the rest of the world, and not so much the PE as the earnings. Most of the outperformance of the US market in the last 10 years has come from extra earnings. And over 80% of that extra earnings has come from this handful of FANGs. Now, they are recently sprung out of the venture capital industry. They are a classic demonstration of 50 years ago, 40, 30, 20. That pool of 20 to 50 years of venture capital, these are some of the winners that have become kind of global giants, bone crushing in their competence and competitive spirit. And I think that will continue and that it will be a true advantage for the American system.
Jeremy, is your foundation active in Australia as well?
Yeah, we have a wonderful farming enterprise to sequester carbon through very intelligent pasture treatment.
And if folks want to learn more about that, how can they do that?
But they can send me an email and be patient about getting a reply.
Well, this has been a fun conversation. I wanted to end it on a very specific note because at the start, you mentioned that you've taken some time in the past year just to read a little bit more. And I'm interested, and I think our audience would be interested, if you just share a few books that have left an impression on you and ones you'd recommend that others maybe consider as well for their reading.
I'm afraid I've been very nerdy this year because a lot of it has been on regenerative agriculture and green stuff, which is so exciting. I've just started a biography on the American woman who got the Nobel Prize in Chemistry the year before last, and about gene splicing. And it's by the guy who did the biography on Steve Jobs and
right.
another very famous one. And so that's the one I'm working on now. And the rest of them would have everyone rolling their eyes in boredom because they're all quite technical.
Yeah.
But
sorry, go ahead.
No, I would say when I get to this woman in gene splicing, she's involved in things that have terrific implications for agriculture and how you fight bugs without putting toxic chemicals on. You send a message courtesy of messenger RNA like the vaccines, and it turns off the switch of the Colorado potato beetle, and it can't process carbohydrates. And we are investors in a firm, it's called Greenlight in Boston. And so the Colorado beetle eats the potato and dies of starvation and falls to the floor of the field and is eaten harmlessly by the other insects. Changes everything. By the time we finish gene splicing, we'll all have IQs of 150, and maybe we'll be programmed to be long-term investors as well. No doubt we will have a value bias as a consequence.
Well, it's been a fun conversation. I started at the outset by asking you just how the last year has been, and you referenced the fact that, among other things, you haven't been traveling.
Like most people, I'm looking forward to seeing family I haven't seen in distant parts. In a week, we fly to California, and then when the Brits finally let us in, I'll go there to see a lot of family.
Well, that sounds wonderful, and I do hope you get to reconnect with friends and family as much as hopefully everyone would like to. But thank you for joining us. It's been terrific as usual, and really appreciate the time you carved out here. Thanks so much.
Yeah, thank you for having me. Bye-bye.
Bye.
Well, that was certainly a very thought-provoking way to open the conference. We're going to hear a range of views over the next 2 days. That was definitely the bearish one. Be hard to top a more bearish view than that, I suspect. As I mentioned at the start, CPD points are available for each session that you attend, but of course it is important that you are logged in so that we can track who has attended those. So please, to get your CPD points, make sure you're logged in for the appropriate sessions in order to get those all-important points. Coming up now, we've got a range of Meet the Manager sessions over the next couple of hours. First up, we've got a great session coming up from PIMCO, the world's largest bond manager. Plenty of interesting insights there on all things fixed income, and our principal sponsor for the event this year. Followed by that, we've got a couple of sessions from Metrics Credit as well as Yarra Capital. Behind them, you've got a couple of sessions from Munro Partners as well as MFS. And then finally, we've got 2 sessions from GQG as well as Capital Group. Certainly plenty of global equities discussions coming through there. And then rounding out the morning and into lunchtime, we've got a really fascinating session discussion coming up with a gentleman by the name of Hiro Mizuno, who's the former Chief Investment Officer of the GPIF in Japan, which is one of the world's largest pension funds. He's going to be having a discussion with our own CEO of Sustainalytics, Michael Jancy. They're going to be chatting about all things sustainability and ESG and how you incorporate that into portfolios in a big level. So please jump into the Meet the Manager session over there, and we'll look forward to hearing your feedback on all of those.